Much of what I'm going to say is a little bit of a rehash and condensed version of a talk that was held in London last week with IPD launching their logistics benchmark and performance index, which is a very timely moment, and from our perspective it's something that we now contribute to, and we think that index, along with some of what I'm going to talk about, is leading to greater institutional interest in the sector. I thought it'd be useful just to frame our conversation for today and just give you a broad overview of the sector. At the moment, the sector is trading on an annual basis in terms of investment volumes at 8 to 9 billion euros per annum. 2011 was about 9 billion euros. The start of 2012, we're seeing a slight decrease in trading volumes, although I do believe with what's in the pipeline and going on in solicitors' hands at the moment, those volumes will be up before the end of the year, and again will be in the order of 8 to 9 billion euros by the close of play. That, in the overall context of the European real estate investment market, is about 8 to 9% of total commercial real estate that's traded. So it's a relatively small universe. From a CBRE perspective, what we see and what we do, we have about €1 billion of logistics assets that are currently under offer and in solicitors' hands across all the main markets in Europe, and a further 600 or 700 million that we're marketing, and much more than that we report on. So our perspective is quite broad. We think we get to see a lot of the flows that happen in the market, and so my perspective now is based on kind of day-to-day agency and brokerage work that our teams are carrying out. This slide I put up, and I'm not going to put up too many statistics, but it's really just to illustrate the change in geographic focus. For the last 4 or 5 years until this year, the spread of investor focus and trading volumes has been very, very similar. The UK has made up 40 to 50% of logistics trading activity, closely followed by similar volumes in France and Germany at 10 to 11%. Benelux has been slightly less than that, and Central Europe has usually been between 5 and 10%. Where we've seen a big shift in capital flows currently, and again it's timely being at Expo, is to Germany. I think the investment themes that are running through the logistics sector at a macro level are very similar to the rest of the real estate capital markets world, and we're clearly seeing indications that Germany is much higher on investors' lists, and as a result is benefiting from that in terms of activity and volumes. Part of the conventional rationale for logistics, and a thesis that we've been promoting for a while, and a lot of our clients and customers believe in, is that in a lower growth environment or a more uncertain economic world, that logistics has more defensive investment characteristics, more closely linked than other sectors to the bond market. So that means a higher proportion of its total returns are made up of income that is generated, and the statistics have also shown that it has a lower volatility through the cycles. We decided to look into that into a bit more detail, and sensing that there was more institutional appetite in the market from the conversations we have, the types of meetings and investors we're seeing at the moment come through our offices and teams, we teamed up with Mercer's, and this was a report that we co-authored with Mercer earlier in the year, around May or June time, and we wanted to look at logistics, or industrial and logistics, in the context of an actuarial consultancy role, and looking at weightings and the rationale for investing in the sector. And we wanted to be a bit more rigorous in how we did that. So we provided all our performance data, indexing and benchmarking to Mercer's, and allowed them to run it through their actuarial models, comparing industrial and logistics with the other real estate sectors, being offices and retail, but also in a wider investment universe, including bonds, equities, and cash. And without going into too much of the detail behind it, because that's very much the Mercer's field, we looked at the main 4 parameters that global institutional investors are concerned with at the moment, the things that Mercer's are advising them most about. The 4 main dimensions are income return, inflation-related returns, liability matching, and total efficient returns, risk-adjusted returns. And what this table, which I hope you can read behind me, shows is that industrial and logistics, on most of those main parameters, compared to the other main investment classes, actually performs very well. Certainly on the income return, it's ranked number 1, and in terms of efficient total return over a longer period of time, I think this was 10 years, when we believe the logistics sector really started to grow up in mainland Europe and be developed out by the major groups that were arriving, it ranks number 2. For inflation-related returns and liability matching, it's a bit more of a complex picture. It still fares well in relation to most other asset classes or in combination with asset classes. But the long and short of it was that the conclusion was logistics as an investable asset class has a compelling story behind it, and it's one that Mercer's can support from an actuarial standpoint, and they would recommend increasing allocations to the sector. So both on a turnover volume and actuarial standpoint, we are seeing a maturity in the sector, a growth in interest in the sector, which we think will be shown in the trading volumes and activity that are going forward into next year as well. So that is the longer term picture. In the shorter term, again, just to set the scene, the picture is a bit more complicated and it's mixed. And it's very hard to stand here and give a presentation on a European-wide basis about every individual market. But I'm very happy to answer questions on that afterwards, along with the other panelists. What is quite clear is that depending on where you're positioned in the market currently, your experiences are going to vary dramatically. And I would best characterize the market as fragmented and polarized. I've listed here 6 points just to touch on, and again, we can discuss them in more detail in the panel session. One thing I want to look at is the availability of debt and equity. Despite the kind of headlines for real estate and generally, and the negative outlook for Europe and the recapitalisation of the banks and some of the macro negative sentiment around, there is significant amounts of equity and debt available for logistics. We are not experiencing that as a problem to limit the volumes that we're involved with, but it is increasingly focused on a smaller and smaller proportion of the market. And the difficulty is where you draw the line in terms of where your investor requirements lie. Secondly, cross-border activity versus domestic activity. This is a part of the discussion which we spend a huge amount of time debating, particularly when we're pitching for new business. How sales and transactions are positioned, the strategy behind them. We've got the statistics to prove it. Pre-2007, there were increasing growing volumes of cross-border international activity that were the majority of the market. That shrank to about 25% in 2009 and has slowly been growing. This year, I think there'll be more cross-border activity than last, probably representing 30 to 40% of the total market that's transacted this year, albeit it's not going to be on the basis of multinational portfolios. It's very much on country-by-country portfolios. So there's been a change there. Also, for individual assets, it's quite clear that the domestic investment market is operating differently, and that is where we see more competitive tension right across the board. Third point, geographic targets. This is polarized. I think I just touched on that. German, we've seen a material increase. The southern European states, and as you get out of into Eastern Europe, and I mean beyond the Central European markets, there is quite a clear divide. So when looking at the overall statistics, those markets are significantly depressing the overall numbers, which is disappointing. Within that, in the strong markets of Western Europe and Central Europe, I think the statistics are actually positive and compelling. We can touch on that in more detail. Fourth point, the definition of prime and the definition of prime logistics seems to be continually debated. It is a major factor which I think is frustrating a lot of transactions. It's frustrating the raising of new equity. It's frustrating new capital being deployed in the sector. There is still a difference in the perception of what exists in the market and what new money feels should exist in the market. We can come back to that. What is quite clear, the definition is narrowing all the time. And as a result, that links into my fifth point, which is the polarization of pricing and liquidity. For prime, top quartile assets, pricing has remained stable. In some markets, it's strengthening, and I think will continue to strengthen given the yield profiles we're seeing on deals that are going through at the moment. Once you get outside of that, if the market's trading for prime in the low sevens, maybe special purchases or exceptional locations, sub 7, but broadly 7 to 7.5 across most of the main markets now. Central Europe, 7 3/4 to 8% for prime. Once you get outside of that, again, it's very hard to draw the line, but yields will move out by 150 to 200 basis points very, very quickly. Or it becomes an even more binary number and the assets just aren't liquid. So navigating the market at the moment for us and for our clients has never been more difficult, and everyone has a different perception of what things should be priced at. Final point, just to mention, one of the fundamental drivers of the market and something that's close to all our investor clients' hearts is what the occupiers are doing and leasing activity. Again, the picture here is completely mixed across Europe. You've got occupiers and operators on one hand going bankrupt. We're seeing vacancies increase in some portfolios and some markets, and experiences can be quite gloomy. And another part of it, they're rationalising, and by that usually means contraction in some areas or rationalisation and expansion of others, new requirements for developers in some markets, which is creating new product and development pipeline, which is coming through much more strongly at the back end of last year and the start of this year. And then you have some who are rapidly expanding, and we're going to touch on this, but it's e-commerce, also the trend towards 3PLs. I'll mention names like DHL and Amazon as well publicised operators in the market. If you're in that space, your experience will be very different again, and many of our clients are benefiting from that. As a closing comment to throw out for the discussion with the panel today, I'm going to be slightly bold, and before coming here, we drew up a list of our top 20 clients and put an approximate number on their current holdings. And in my mind, what they have in their holdings is about 17.5 billion euros of logistics. And from where we're sat, we believe there is going to be a material, structural capital markets change to potentially 90% of those holdings, which is a massive number. Now, that won't necessarily result in direct real estate transactions. That is a change in the capital structure indirectly with what makes up the European continental markets. And one of the thoughts I want to leave people with is that unless you're aware of what is going on structurally across the market at the moment and within the fragmented nature of domestic countries and then the sub-markets within those, it's going to be very, very difficult to position yourselves for outperformance of the sector in the future. And it's also going to make it increasingly difficult to access the parts of the market that you might want to be in, because once these structural changes happen, they'll be locked into new joint ventures, recapitalised vehicles, new funds, making the investable universe and volumes even tighter than we're seeing today. 12 months ago, I wouldn't be stood here saying that, but it's quite clear from what's going on. So I'll leave that out there, and perhaps you'll be generous enough to ask some questions from the audience and challenge the other panellists who are on here today, so I get to avoid asking them any difficult questions. But that concludes my scene setting, and if other people can join, that would be great.